All right, guys, let's continue. Okay, so I was talking about pip movement and pips. Pip is actually used to calculate how much a percentage has actually a currency has actually depreciated or actually increased in value. So, for example, dollar. So dollar for Ghana cedis against dollar. Ghana cedis against dollar is actually giving in like let's say two decimal places. So let's say we can always sometimes see dollar cedis Ghana cedis being like 16.31, 16.40, 16.19. It never goes to four decimal place. So for every pip movement, the last decimal place is counted as a pip. So for some currencies, we see they have five decimal places. So that means their last decimal place is their pip. And for some currencies, we know they have four decimal places. That means their fourth um, decimal place number move is a pip. So if they have four decimal places, let's say they have 0.0013, and the currency moves up to 1.4. That 4 means there's a change in pip movement. And how many pips have they actually changed? One pip. If we move from 1.3 to like 1.7, how many pips has it actually moved? Four pips. So the currency has actually moved four pips. So sometimes you see a trader seeing dollar or Ghana cedis move from 16.0 to 16.98. And the person will be like, okay, the currency has actually moved 98 pips. And people will be like, what is pips? What is this person saying? What is this person saying? Basically, what the person is trying to say that the currency has actually increased in price and in how many um, points has actually moved. That's um, it has actually moved 98 pips. And some people also put it in an abbreviation, but people say it's also an abbreviation, which means um, percentage P in, let me write it, percentage, let me type it, that would be good. Some people say pips means percentage in price or in price increase or something. Like some people say it like that. They say they want to put it in an abbreviation and that, and that's how they put it. But basically, just understand that the change in one currency is per the price. Either it increases or it decreases. That is a pip move. That's a pip move. So basically, this is what pips means. If a currency increase or depreciates in price, the increase or decrease in that is what we call pips. And I hope everyone understands it. And if you don't understand, you need any explanation, just raise your hand. I'll just give you a chance to ask. But if you can't raise your hand and speak, also, you can just type it in the chat box. So it's best you type it in the chat box for me to explain it to you. So let's continue. Lot sizing. So one thing about before I speak about lot sizing, spread, and these terminologies, let me first talk about things about the market and how these things even come to play another. You see, about forex exchange, it wasn't that common for people to get on the market and be buying and be selling. It was done by people who had money, rich people. And how it was done was we had people who actually educated themselves to the point where they can take money and trade. It was actually done by specific people. It was really done by specific people. There wasn't a time like it was just in this late or this early 2000s, 2009, 2008, where people were given the chance to actually trade personal accounts. Until then, it was done by companies. It was done by brokerage companies like brokers. They had um the systems, the licenses to trade the market. So what they do is they call people who had money, ask them if they are willing to invest in them to trade for them. And at the end of the day, what they do is they take your money and use it to trade for you. And at the end of the day, they take a percentage if you win. If you lose, you lose. If you win, they're taking a percentage. And I know if you lose, they still have their percentage to do, but that was how trading was done. So now trading has actually evolved to a system, a way where people can just sit at their homes and trade. And how do they trade? They trade through another system. So this means that if this system was not actually created, individuals will not actually have gotten the chance to be trading personal accounts. And this system is actually brokers. Brokers are systems or um, ways where individuals can connect with the market itself. So instead of you going to create licenses, get that to trade, what you do is you register with a broker who has licenses to trade the forex market. Then you have the chance to enter the market through them. Like they give you a passage for you to make your orders through them. So instead of you making your order by going straight to the marketplace, what you do is you make your order like, let's say, you'll be like a waiter. They ask you, what do you want? What do you want to buy? What do you want to sell? And you'll be like, okay, I want to buy the dollar against USD. So against pound. So now how can I buy it? And be like, okay, this is how, or these are the ways you can buy it. And they give you the access. So if you buy it, that's when they take your order and take it to the market for you to or for it to be executed. And it happens so fast that like real time, it's actually a real time something. So they are actually real time waiters. Instead of you see, if you go to a restaurant, what the waiter does is he takes the order, goes to let's say the chef or someone to prepare it for you. For here, what the broker does is immediately you make your order is sent straight. There's no waiting. That's what we call real time. Like it happens as you do it. I get it. So this is what brokers do. They give you access to access the vast market where the 6.6 trillion market dollar goes through the market. They give you access into the market directly. And this is what brokers do. And what do? They also give you leverage. And I want to start with leverage before I come to lot sizing and also talk about spreads and all that. So leverage is basically the market enhancing what you have. So let's say a lot of people who don't have, as I said, I made a statement when I started, I was like, who rich people actually had a chance to trade? Rich people. So now if you have $10, you have $20, you have $30, how are you going to trade in this market if it's only made for rich people? That's where you start to understand that the markets or these brokerages did something that enhances what you have. And what they do is leverage is basically like a lever, like a pulley. No, pulley is actually used to make sure if you are lifting something and it is heavy, pulley makes it easier for you to lift it. This is what leverage means. Leverage means you want to get on the market, your money is so small, and the market is trying to make your money so big so you can um your money, the life, that money you're actually using to trade will look like something huge. That means the more your leverage, the more the chances of you losing your money, and the less the leverage, the less the chances of you losing it. So basically, if you have, let's say, leverage is actually given into in ratio. So let's say if you have a leverage of 1:50, that means if you have one with you, it's actually being magnified as $50. If you have $1, your $1 is being magnified as 50. If you have 1:1,000, that means that $1 is actually being magnified as $1,000. So look at this. It actually makes it um it's actually a virtual thing, but it's actually something that actually helps you as a trader to trade because you can't go in with millions to trade. You can't go in with thousands, 100,000, 10K that to trade. But if you have little, the market is ready to magnify it and make it look good on the market for you to be able to execute your trades and all that. So now let's get back to spreads and we will talk about that. So I wanted you guys to know leverage and understand leverage and how brokers actually use that to help you. And yeah, let's talk about the lot sizing. So lot sizing is basically how much of a thing you need on the market, how much of it. So before that, let me give you a case scenario. So let's say, for example, the price of um let's say the price of let's say okay, let's say for example oil. The price of oil is, let's say, 1,000 cities, because I want to use this case scenario because of how oil actually had this increasing price in COVID season when we were in COVID, how it increased. I'll use it to explain something here. We had thousand, let's say, oil, one liter, that, like, how much was it? Was it 1 liter? Okay, let's take for example 1,000. And now I said something about pips. I say pips is how much that actually the price has actually increased or decreased. And let's say the market, um, let's say you want to buy oil, you want to buy oil, and you went and you're buying a quarter of it. So that means if you are buying a quarter of that 1 liter, how much are you going to pay? You're going to pay a quarter of the amount. Are you getting it? So that quarter you are buying is equivalent to a lot size. So that means if you are getting on the market and you want to buy something on the market, you are trying to tell the market that, okay, now if if $1 is, let's say, $1 to cities is 16 cities. I want to buy, let's say, 0.01% of that. That's, let's say, the minimum lot, 0.01. And that means for every pip move, for every 10 pip move, you get, like, let's say for you have every 10 pip move, let's say from 16.30 to 16.40, what you're seeing is 10 times this, you are just making one $0.1. You're just making 0.1. So this is how pips works. Pips works when you see how the lot size works basically is how, let's say, you have a one lot size. Let's say, for example, let's use for his example, because sometimes I just want to use the simplest kind of example for you guys to understand that it happens everywhere. Because if we are using the currency pairs like the GBP, USD, and all that, it makes it difficult for you to understand. But understanding it from your own perspective also helps you to understand it very well. So, for example, here he's saying that if you use one standard lot size, you earn $1 per point. But now, if you are using, that means if they say for every pip move is $1, I said if you are buying the whole 1,000 cities, if you want to buy, let's say, for example, you went and you said you were buying 1 liter of oil, you are paying the whole 1,000 cities. So for every increase, so let's say if you go to a place, you bought 4 liters of oil, and when you went, you had 4 liters of oil, but you said you're buying one. So now, if one is taken out of this, how much are you using? I'm actually losing for that. You're losing a full 1,000 cities. Are you getting it? So let's say if you now buy um 0.5, how much are you actually going to lose if you lose that oil? You're going to lose 500. That's how lot size works. Lot size works in a way that if you don't have enough to buy the whole amount, you can buy a percentage of it. And that means if you say, um, let's say dollar pound is actually like $1.3. Let's say euro dollar. The first one we did, like euro USD is 1.3. And you want to buy one standard lot. That means for every single move, you're going to lose $1 or something equivalent to this amount for every single move. If you're buying the whole, for every single move, you're losing that. But if you're buying a standard lot, like let's say 0.01, 0.02, 0.03, that's where you know that for every standard move, you are going to lose 0.02. That's how the lot size works. And this increase or this decrease in this amount, it varies. It varies. I getting it? It varies for every single pair. It varies. That's why we say there are pairs which are actually volatile, there are pairs which are actually less volatile. And why are they saying that? Because some pairs move faster than some pairs. So by the time you actually blink, your money will be gone. So for the table, I think there's a simple table here for you to understand simple lots and standard lots and actually mini lots. But basically, lot size is actually how much of a pair you want, and it actually affects the amount you have on the move. And this is a clear example. Like, yeah, for example, if you have a 10 pip move and you're using, for example, 100 pip move, as I explained, 100, this is actually a 100 pip move example. So let's say market has moved a 100 pip move and you are using a standard lot of like 0.01, you are basically going to just make $10. And that means it moves against you, you're losing like 10. If you're using the 0.01 lot, you're actually going to make $100. But at the end of the day, if it moves against you, you're actually going to lose. And if you're using a one lot size move, it's actually going to you're actually going to make 1,000. If it moves against you, you're actually losing the same amount, as I said. But here, look at something. Pip is always one, like let's say, let's put it like this. Pips is basically equal to points over 10. So it's sometimes kind of confusing, but it's basically the points you run it to just one decimal place, just move one decimal place there, and you have your points. So as I explained, if you want one lot of oil, which is $1,000, at the end of the day, if the market moves against one lot, you are losing all that 1,000. But if you divide it into two and be like, okay, now I want to buy just half of it. If you lose that half, you're going to just lose 500. And that was what I was actually trying to explain to you guys. But I'll just try and do an explanation anytime you come back. If you have any questions, you can just clarify on that and all that. Yeah. So now let's move to the other terminology, because from tomorrow we just get on the chat. I want to just finish the terminologies and all that. Just get to the chat, give some example or real life example about these things we learned and move on from there. So okay. So as um I said something about those guys who actually exchange money, like the bid, like those people you be like you go to sell, let's say you have dollar on you, physical dollar, you want to sell it. You go to them and you be like, okay, we buy the dollar at 14 cities, but if you want us to give you dollar and you pay us, we will sell it to you at 17 cities. So now, if you look at this, let's say you look at this, can you see there's a kind of a $3 difference? Or okay, 3 cities difference. So this move, these guys, the distance between these two guys is what we call spread. These guys is what we call spread. So spread is actually not a term for it's like it's not actually a term that was derived on the forex market. It's a mathematical term. It is actually used in data like statistics. Are you getting it? Spread like a set of numbers between a specific zone to zone. Are you getting it? So basically, if we have 16 cities, for 16 cities, 35 Ghana cities, and 15 cities, 20 cities, 20 pesos. And you get on the chart, you're going to see something like this, two lines, one being green, one being red. And this is going to be the ask price, and this is going to be the bid price. And you see, basically, what you're going to see is the ask price is what, and the ask price is what they want to sell it for. and the bid price is what they want to buy it for. So now, if you get on the market, the distance between these two guys, what they want to buy it and how they want to sell it is what we call the spread. So some people have this wide spread, and this is because if you say people have wide spreads, that means the amount they want to buy it and the amount they want to sell it is so huge. The difference is so huge, and that's what we call spreads. So don't be confused when you see the market having two prices for buy and sell. Basically, the difference between them is spread. And for you to know how big a spread is, it depends on how the difference is, how big the difference is. So this is basically spread. So that's why they give an example here. The spread on AUD USD is if um you go on the chart, you're going to see that it is maybe buying at this point, by selling at this point, and the difference between them is what 10 pips. And the importance about this is it helps you to know where to put your SL. Because if you are entering into a market, for example, this statement I just made it for uh, intermediates and those who are advanced, so they can understand what I'm trying, like something here. If you're a beginner, don't worry, you get to understand it. So let's say you are entering the market at this zone. This is your entry E, and this is your SL. Sometimes you have to put in an account that if my spread is 10 points, I have to add that into my SL. So instead of putting my SL here, I have to bring it somewhere here. I'm just giving an example. It shouldn't be that, but if you calculate your pips and you understand your spread, you can increase your spread because people will be like, okay, it didn't hit my SL on my chart, but when I went to my MT5, it actually hit my SL. Yes, because you didn't put your spreads into account. The um the broker you're using to do your analysis on trading view is not the same as the broker you're using to take your trade on MT5. So why do you want it to be the same? It shouldn't be the same. Yeah. So it's something you should also put into account, or if you know already, you know it. If you don't know it, just try and add it to your trading um like knowledge or something. So I've talked about leverage and what. So I think this is okay for today. Tomorrow we get into the buy and sell and some few things about the currency pairs and all that. But today has actually been a choppy day. Like we started a meeting so well with some people speaking that made the meeting so messy. So I think we can end here. And if anyone has a question, we can use the rest of the time we have to answer the questions and all that. This actually haven't been the best meeting, but I think it's okay for day one. Day one actually didn't be like didn't go as planned or that. But if you have any question, you can just raise your hand or type it in the chat box. I'll just reply yes, move on. Oh, sorry, guys. I just got notified that the chat has actually been disabled. Sorry. All right, so I think you can now chat now. Sorry, guys. So you have any question, just put in the chat box. I'm ready to answer you guys. Okay. All right, please, you have any question, you can just let me know. Yeah, thank you very much. Thank you very much, TK. All right. So someone is asking, he said, I saw the spread was in percentage in the slide. My question is, how do you convert the percentage to pips? All right. Let me go back to my slide again. Yeah, the slide I didn't prepare myself. So now, let me go to my slide. So you see something here. This wasn't a percentage. It was them trying to tell you that if um your spread is 0.01, just know that there's always going to be $0.1 on top of the amount you're Rexing. And that means I said something here. Knowing how big your spread is the difference between the ask and bid price, or the difference between the buying and the selling price. So let's say you are buying the price at 0.6 and you are selling it at 0.7. What is the difference? 0.1. So if you are the difference between your buying and selling price is 0.1, that means your spread is 0.1. So if your spread is 0.1, put it in mind that immediately you enter the trade, you are already at a loss of minus $1. That's why people be like, why do I have to be in loss if the market never did a drawdown? Yes, it never did a drawdown, but the spreads was taken into account. So if you start to understand this, and you start to understand that, oh, nothing happens on the market just like that. They all have a reason. That's why sometimes you never got into drawdown, but you see yourself in negative. This is because of the spreads. Are you getting it? So if the spread between the pair is one, um, let's say for example, let's say, um, for example, I'm sorry about that. Sorry about this value. Sorry about that. I'll explain it again. So let's say, for example, 10, and you are opening a lot size. They are using this example. I just made a mistake here. The difference between them is 10. The difference between these two pairs, you see, they are actually buying it at 0.66310, and they're selling at, let me use the last two numbers, 20. So if you deduct this from that, you're making 10 points. That means your spread is 10 points. And how many points did I say? If, let's say, if your spread is 10 points and you're opening a lot size of 0.1, what did I say? That means for every move, 10-point move, you are going to lose what? 0.1 hot dollar. So that means if for every 10-point moves we're using actually $0.1, the same will apply to your spread. So let's say if you are losing $0.1 already, and your spread is also 10 points. That means at the end of the day, the first drawdown you're going to get is what? 0.2. Your spread is always added to it. Your spread is always added to your drawdown. So this is it. If you open a 0.1 lot size, you are actually losing $1. If you're opening a $1 lot size, you're actually moving $10. So if you're in a drawdown of $20, just know that your spread is also included here. It's not just the market moving against you. Your spread is also included. So if you're putting your SL, try your best to add your spread to it. Just know that your spread is actually included. So don't neglect it and say you hit SL, you never knew that. All right, please go over the spread. I think a lot of people want me to go over the spreads again. Okay, so I think this is the spread basically. So let me give my own example, not from theirs example. Myself, I just want to use Ghana cities because I know a lot of Ghanaians are here, and it's actually going to help us understand the cities. If we see the cities increasing, we know that yes, the increase the increase is actually increased like this. The cities is actually increasing by let's say 10 pips, that, and it's actually a flex. You see, so let's say we see cities 16.30, and this is the amount you are buying it, and you want to sell it at 17 cities. What is the difference here? 0.7. And what is that point? This is a 10-point move. This is actually, oh wait, this is actually a 70-point move. Are you getting it? 70 points. So let's say, for example, 70 points. Hooray, 70 points. So that means if you're opening a lot size of 0.01 with this kind of spreads, that means for every move, for every 10 points, this is 70, right? For every 70 points move, what you are going to lose is 0.1 or 0.01 lot size times 70. And that's 0.7 USD. So that means for every 70 points move, you're losing this amount as spread. So spread is also counted into your drawdown. That's what you're trying to say here. It's also counted into your drawdown. So if you enter into a trade and you're actually in a trading, the trade is actually in drawdown of, let's say, 30 USD. You just have to put it in mind that your spread is also included. It's not just the market moving against you. Spread is also included. So for a real life chart, let me share my chart for you to understand this very well. Let me share my chart. So for a real life chart, this is a good chart. Nah, I don't want good. I want Euro USD. Yeah. So this is Euro USD chart. And let's see something here. Oh, zoom in. Wait, let me zoom in. Oh, to zoom in. Okay. Because of you guys, I'm zooming this thing in. But all the same, I'll try and bring it back again. So yeah, can you see the price here? Let me bring the ask and break price. Mm, where's the ask and break price? Ask and break price. Okay, okay. Let me go into the smaller time frame. Guys, are you seeing something here? Look at this. Have you seen first line and the second line? If you can see it, give me a thumbs up if you can see it. There are two lines, the blue one and the red one. Can you see it? If you can see it, type into the chat box, like be like, yes, you can see. We have some few minutes to go, so I can just explain. Okay, okay, I think you guys can see it. This is what the market is trying to say. If this is the price they want to buy it at, they want to buy it at oh, why is the market moving? Okay, market is opened 1.089191, and they want to sell it at 1.08201. So let me write it down so I can do the difference. So 1.08203, 1.09191. 1.08. Oh, it was 1.08191. So if you check the difference of these guys, so let me use my calculator to check the difference right now and get back to you guys. 8203 minus 1.0891. Okay, we are going to see that the difference between these two guys is 0.00012, and that's a 12 point or the 12 point That's actually 12 points. So if the market is basically trying to tell us that the spread between the euro dollar is 12 points, that means for every single peep move, let's say for every single, if you are opening at $0.01 lot size and you you actually market actually move against you, in spreads, you're actually going to lose 0.012. That's why immediately you open the lowest lot size, the market ticks, you see yourself losing this amount. And this is what we call spreads. The difference between the buying and the selling price. This is spreads. This is a real example of spreads. Are you guys getting it right now? So yeah, we have less than 2 minutes to go. If you still have any question, just let me know in the chat box and I'll play you out until we go tomorrow. Tomorrow, you're going to do a lot of things. So kindly come with your notebooks, pen and paper. You're going to do a lot tomorrow. Today was just for the basics, brushing through some few things and all that. All right. If okay, is the test based on empty 5 hours? Let me check. MT5. Okay, let me also talk about this. See, on MT5, we have the same thing, the ask and bid price. It is given in green lines and red lines. Yeah, we can also use that to also do your explanations, but I haven't seen a third line or something, third space or something. Okay, that third line is actually on the chart because it helps you to know where the chart is at the moment. It knows where, like, actually know where the price is at the moment or the point or at which the candle is actually at. You know, when the candle opens, it opens with it helps you to know where market or the candle actually opened and where the candle is actually closing and the current position of the candle. Are you getting it? And day percent.